Okay, let's get started. Good morning and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I am going to be walking you through how I am viewing the current markets. So before we get started, just the usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today will be starting off with the major equity indices, highlighting those key levels. From there, we'll be moving on to fixed income commodities and taking a quick look at Bitcoin. We'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall market. We'll take a look at some of the subsectors of interest that I have for you over the last few weeks, and we'll end today's session with some bullish and bearish market observations. So before we take a look at the major equity indices, just taking a look at the Fed rate hike probabilities. So we do have another Fed meeting tomorrow. However, I am looking at the following Fed meeting after that, which is on the 22nd of March. The reason I'm doing that is because we know that there's going to be a 25-point hike for tomorrow. I mean, most likely the Fed futures are pricing in a 99% probability of that happening. So there's not that much, it doesn't really make that much sense to really talk about that. Important thing to note for tomorrow will be Jerome Powell's speech and the forward guidance from the Fed, indicating how long elevated rates are expected to be. That's going to be a huge market mover. So it's not that tomorrow's announcement is that it's not that it's not important. It is important, but we know how much rates are going to move. It's just the forward guidance that markets are now looking at to gauge the future direction for equities and for bonds as well. But taking a look at the following meeting, remember we have the current rate is now 425 to 450. And we will most likely get a 25-point hike, taking it to 450 to 475. But on the 22nd of March, right now, Fed futures are pricing in the highest probability of 84% for rates to be at 475 to 500. So taking into account the 25-point hike that we will most likely be getting tomorrow, another 25-point hike will take it to 475 to 500. So basically, we are pricing in two 25-point hikes, which makes sense. You know, I can't imagine interest rates or a hike more than 25 points, unless something crazy happens with inflation, which is unlikely. I mean, it is on a downward trend. So for now, 84% or 85% probability of two 25-point hikes. That being said, we do have a lot of economic events leading up to that meeting, such as another inflation announcement, two jobs reports, one this week, another one in March. And overall, GDP data, CPI data, these things are what the Fed will be looking at to gauge whether we will need another 25-point hike. So I do expect this number to move a little bit, but again, depends on the economic data that is coming out. So shifting our focus here to the major indices, taking a look at the S&P 500 using the SPY ETF. Now, last time we spoke, we saw price was near its 21-day exponential moving average, moving a little bit higher after that pullback. And it did manage to reach pretty much the 410 area or so, major resistance on the daily time frame. Intraday rejection and bearish price action yesterday, set to open a little bit lower this morning. Now, there isn't, other than the technical levels of 410 acting as clear resistance area, there isn't anything fundamentally driving this move lower or this pullback. And that's how I view it. I view it as a simple pullback ahead of what is going to be a very volatile end of the week. Tomorrow we have the Fed meeting and the Fed speech. Thursday we have Apple, Microsoft, and Google announcing earnings. So three of the largest companies by market cap announcing earnings on the same day. Hugely volatile event on Thursday. And Friday we have jobs data as well. And, for coming into this week, I think my overall trading plan would be to sit on my hands. There's too much unpredictability this week, too much high volatile news impacts this week, and I'd either be trading really light or simply sitting on my hands and waiting for the storm to kind of pass, heading on to next week. But for now, we are seeing what I believe is more profit taking or just some just a slight pullback before the fundamental events dictate future direction. But the key levels here are between 380 and 410. So price is pretty much, near the middle there. So not much to say for the S&P 500 because it's going to be the fundamental events this week that are going to really dictate where the price hits that 410 level or moves all the way back down to its exponential moving averages and potentially that 380 level. However, we are seeing overall on the weekly time frame a bit of capitulation, right? We are seeing sorry, 1 second. There we go. We are seeing a bit of inverted head and shoulders, price finding a bottom near the 350 level, which is also the 50% fib level, and also finding support on the right shoulder at the 380 level, which is also the 38.2 fib level. So clearly respecting a few key areas. However, you want to take a look at the daily time frame, and with the daily time frame, we do see 410 and 380 being the key levels. Also, should price break above 410, we have 420, that 428, 430 area as well as the next key resistance area. Overall, my outlook here for equities is definitely a bit more of a risk-on environment, which is positive for equities, especially for growth stocks moving a little bit higher. However, the theme for 2023, especially for the first 6 months, has been this tug of war between will we get a recession or will we not? So recession fears are definitely leading the way. Last year it was interest rate movements. However, we have more clarity with interest rates and also lower interest rate increments of only 25 points. The only unknown is how long it will be elevated for. But recession fears are also playing into price action. And right now, I'd say news is a bit more optimistic that we'll avoid a hard recession. We'll get more of a soft landing, which is why we are seeing equities start to trend a little bit higher and rebound. So those will be the key levels that I'll be looking at here for the S&P. NASDAQ 100, similar price action. We are seeing price again react to that 300 key area of resistance that we highlighted last week. Set to open a little bit lower again this morning. But again, like the S&P, bit of a pullback, bit of potential profit taking ahead of what's going to be a very volatile event. We have support on the weekly time frame between that 270 to 260 area. And overall, next key area of resistance after 300 is near 315 and then 330. So a few key areas there to be aware of for the NASDAQ 100, but we are seeing a bit of capitulation here, a bit of support. Worst case, we may see another retest of that major area of support before it move higher. And in that case, it does provide an ideal risk to reward bullish entry point. A break above 380 though would be quite significant because that is a key area of resistance on the weekly time frame as well as the daily time frame, and it would open the door for a revisit to that 316, 320, even 330 level here for the NASDAQ. Momentum overall has been improving on the weekly time frame. Daily time frame has been a bit more of a yo-yo, as you can see. Overall, though, we are seeing a bit of rotation back into growth, a bit more rotation back into technology, which is clearly helping the NASDAQ 100 after what has been, a very bearish year, a very difficult year in 2022 for technology stocks due to higher interest rates. Okay, moving on to IWM, the Russell 2000. So looking at small caps, and these prices perfectly reacting to the levels that we highlighted over the last few weeks. We had the 38.2 fib level at 188, and we saw price rally here, already running into some resistance and showing some bearish price action. So risk to reward does favor the downside. However, we have a lot of fundamental high impact news events this week, and that could very easily act as an upside catalyst for a break above what is a major area of resistance, what is a key area. Now, that's for that reason, I wouldn't really go for short entries here. If anything, I'd wait, sit on my hands, and if we do get a breakout, look for a retest, and from there you have an ideal risk to reward long opportunity, with key areas being 200, previous swing level on the weekly, and as well as a strong psychological level. But you also have 210, which is a 28.2 fib level. So what was I saying? The 23.6 fib level. Forgot my fib levels there for a second. But we have the 210 area, which is a 23.6 fib level. And, potentially a break above that could see price revisit this huge consolidation level area at around below 230. But all in all, small caps definitely back to life in 2023. You know, we are seeing some good relative performance against large caps, which was pretty much missing over the last 2 years. You know, we had during a time where the large caps were rallying, we saw a huge period of consolidation, and we saw underperformance as well during this decline. But overall, small caps seem to be in a much better mood compared to how they have been in the last 2 years. So I wanted to show you this ratio chart here of the growth index or a growth ETF versus a value ETF. And what we are seeing is, you know, this decline here, which means that growth is underperforming relative to value. If it moves higher, it means that value is outperforming growth. If it moves lower, growth is outperforming, growth is underperforming against value. And throughout 2022, with the bear market, naturally growth stocks are going to be underperforming value stocks because we're going to see a natural rotation from growth into value. However, we are seeing a bit of capitulation. Shifting our focus to the daily time frame, we have a previous swing level where price is currently at, and this is a ratio chart, so you don't need to really look at the numbers, more so the actual price action. So we're seeing price, you know, overall have a pretty obvious bearish trend, lower highs, lower lows. But now, after finding this low at 150, we are seeing a rebound on the daily time frame, breaking above the previous swing low. Now, this doesn't necessarily invalidate a bearish structure, because on the weekly time frame, you can see it'll take weeks or months even for growth to invalidate this bearish structure by posting a new higher high, or at least breaking above that 189 level. But what we are seeing is price breaking above a minor area of resistance. You know, this area of resistance acted as support. So it's a classic, you know, bearish trend where we see a retracement back to a previous swing level. However, we are now breaking above that. And that signifies the risk on environment that we are seeing. And overall, I would say that's bullish news for equities in general, because when growth moves higher, we tend to see the major indices move higher with it. So this is something that I'll be looking at over the next few months. And we are seeing signs of capitulation with this breakout above resistance for this ratio chart. Shifting our focus to TLT, the bond ETF. And again, not much to say, you know, last few weeks, it's pretty much been the same thing of previous swing low acting as resistance at around 106, 108. And price once again running into resistance there. So ideally, this is the type, if you want to trade TLT, this is the type of setup you want to see. Price retesting that 106, 108 level. We are seeing here bearish price action or lack of momentum, you know, momentum declining, provides an ideal risk reward bearish entry point for a move lower. My preferred option strategy in this case would be a credit spread, because we're not seeing a full-on reversal lower. We're seeing more neutral, a shift from bullish to neutral to slightly bearish. So credit spreads work much better in this environment. That being said, on the weekly time frame, we are seeing momentum overall increase. No surprise there, considering the magnitude of this decline. Such a huge decline in such a short period of time for TLT, and now it is starting to find a new normal because we know where interest rates are going. So for that reason, I do expect more neutral price action here, with price currently between 108 and 100. Taking a look at the US dollar. So US dollar overall still under quite a lot of pressure, but very, very choppy. Price is still below the 21-day exponential moving average. And even so far today, intraday retest so far of that 21-day EMA, but still, no obvious signs of capitulation. We do have major support between 102 and 100. Be interesting to see how price reacts to that. But with the other central banks now, especially ECB, the European Central Bank, ramping up its rate hiking to 50 points this week, we are seeing that interest rate differential between the Fed and ECB decline. And with that means a weakening dollar, because the dollar is compared to currencies, a basket of currencies such as the euro, the yen, the Great British Pound. So with these banks now, it's their turn to they still have some flexibility to increase interest rates, whereas the Fed is slowing that down, which is why we are seeing underperformance here in the US dollar. And again, no real sign of capitulation. So I wouldn't be surprised to see potentially another leg lower back down to 100. And taking a look at gold. So gold, we are seeing a bit of a pullback this morning. Gold has broken above major levels. Very difficult to get that bullish entry point because it actually hasn't even broken below its 21-day exponential moving average this year. Whereas now we are seeing potentially a retest with price set to open at around 177, another retest of that 21-day exponential moving average. I'll be looking for bullish price action at this around this area, or hopefully we get a steeper pullback to a more obvious key area of support, preferably 171. But after a very long time of outperformance of being in an overbought condition, we are seeing gold consolidate a bit and slightly pull back, and that provides good bullish entry points. Again, credit spreads would be ideal because gold is elevated. I expect it to stay elevated, but the closer it approaches to 182, the more I think, okay, how much further does it actually have to go? So we know gold is a safe haven, and we know with recession fears, investors are naturally going to rotate towards gold. However, and also with the fact that the US dollar is weakening, but the fact that it's rallied so much in such a short period of time does lead me to think that maybe 182 would be a soft area of resistance, and maybe you don't want to go aggressively bullish near that level. So wait for a pullback and then look for bullish entry points for gold, because right now there isn't a fundamental thesis that warrants a reversal or bearish thesis for gold. Right, looking at oil using a light crude oil futures. Last we spoke, we saw price was at this area of resistance at around 82, 83, and bearish price action. I was highlighting most likely we'll get a move lower. We got a retest and then bearish price action there over the last few days. So price is heading lower with 82, 83 acting as resistance, and you have support at around 72. I expect oil to be remaining range bound unless we get a fundamental catalyst that will warrant a breakout of either resistance or breakdown below support. That being said, the next major support level is at 61, and the next major resistance level is at around 90, 92. So those will be the two key areas if we do get a breakout or breakdown. But for now, we need a fundamental catalyst to see a breakout in price or breakdown. And Bitcoin has been overbought for quite some time and is now losing momentum. However, price is still managing to grind a little bit higher, running into resistance near the 24,000 level that we spoke about. And overall, I don't think, even though it's a great idea to be bullish on Bitcoin, in terms of a timing perspective, I'd wait for a much steeper pullback, preferably towards its EMAs or even the 21,000 level, or even lower. Bitcoin clearly benefiting from this risk-on environment that we have in 2023. How long will that last? I'm not too sure. But this breakout above 18,000 is significant. And I will say bullish entries at current prices are just, the risk to reward doesn't favor it. So wait for the pullback. And then if you are looking for long Bitcoin opportunities, wait for the pullback, look for bullish price action. 21,000 potential key level as well, acted as support and resistance. Those would be the areas that you want to buy it as opposed to the current price. Taking a look at sector rotation, we have 5 sectors in the improving and leading category, and we have 6 in the lagging and weakening category. So leading category only have materials, and even there it is showing outward rotation, looking like it's going to rotate into the weakening category and join staples, financials, industrials, healthcare, and energy. Energy, we are seeing the natural outward rotation after a very strong 2022, with oil prices kind of stagnating or moving a little bit lower. And on the improving side, we have technology, small rotation into the improving category, still a lot of uncertainties with technology, but we'll get a more certain picture after big tech earnings as to where the sector will head. Utilities are making a bit of a U-turn, looking like it was heading towards the leading category. And we are seeing some poor relative performance in the last couple of weeks. So it's still staying in the improving category. Definitely a huge improvement from where it was a few months ago in the lagging category, but stalling on a relative basis. And we have discretionary surprisingly doing quite well, finding momentum, looking like it could rotate into the improving category. But still 2023, higher interest rates means less consumer spending. I wouldn't be outright bullish here on discretionary. I think it's just benefiting from a short-term burst in somewhat favorable earnings and just more of a risk on environment. Okay, taking a look at some subsectors of interest, we have KWEB, the Chinese Internet ETF that we have followed now for quite a few weeks. And we've seen a bit of a pullback this morning, back to minor support at 33. This does provide an ideal bullish entry point, in my opinion, because we haven't really seen steeper pullbacks in that. We've seen moves higher, followed by a slight pullback, another move higher, followed by a slight pullback, and another move higher, followed by a bit of consolidation. Now, the Chinese reopening is clearly helping fuel this move higher. And my target price here is 40. With this pullback this morning and yesterday, we even saw yesterday was a huge rejection, intraday rejection of that 33 level, so 34, 33. So there is an ideal risk to reward bearish entry point, a bullish entry point for a move higher. Worst case, we may see another move lower here to 32. Thesis would still remain bullish, but if we see a break below 32, that's when you'd want to cut losses on that trade. But I still see KWEB heading towards that $40 level. Moving on to IBB, which is a biotechnology ETF. And my thesis was bearish on this last few weeks and still is bearish with there are two resistance levels, 133, first of all, which it did invalidate when price moved higher, but 138 was the second resistance level. And that's why I still remain bearish on IBB, because we saw from a relative performance perspective against the overall markets, it wasn't doing quite well. But we are seeing now, again, price react to that 138 level and show some bearish price action. So, which is why I do like bearish entries below or at 138 and below, ideal risk to reward. And I could see a move towards that 130, 128 level. Next key area of support would be all the way at 122. Not sure it'll reach there, but for now, I would be more focused on 128 to 130. So very short-term play. Okay, moving on, we have the semiconductor ETF, SMH. Last week, we highlighted the fact that price is breaking above this 230 level, minor resistance heading towards 246. However, even after a few bullish days, we have seen a bit of a pullback. Price had to open a little bit lower this morning. Bullish thesis remains, in my opinion. It's not a huge reversal lower. I just see, equities have been moving lower as a whole due to the highly volatile week ahead. However, this bullish thesis remains intact with target price still at around the 246, 250 level. And on the weekly time frame, the fact that price has now broken above that 230 area, that's quite significant because we have an inverted head and shoulders. I would argue that 230 area is a neckline. We're seeing a breakout on a daily, potential retest and a move higher here. So risk to reward, in my opinion, even if we do get a bit of a pullback, would still favor the upside, especially in this risk-on environment. Okay, taking a look at some previous ideas that we had, and I only have one new idea for this week. Reason being, it's a very high volatile event. It's a very high volatile week, so I don't want to add too many new positions. Just want to focus on the ones that we already have or the ones that we already discussed, see how they're doing. And basically, the strategy for this week is to sit on your hands and wait for this volatility to pass. So we have Oracle here. Last week, we showed it was a bullish trade because we saw a pullback to 85 and a move higher. So we have seen, again, price reverse a little bit lower, but still within this area of support, still within a bullish structure. Therefore, thesis remains bullish, and I do expect to move higher unless we see, a breakdown below 85. A breakdown below 85 that would invalidate this thesis, but for now, as long as price stays above 85, I'd have a bullish thesis on this. 85, maybe 84. If you look at the weekly time frame, clear area of resistance, and we saw price break out of that. So that is a change of bearish structure to a more bullish structure. Okay, moving on to General Motors, GM. GM was a bearish trade, and we saw, a very good risk to reward bearish entry point for the move lower. Price actually came back to retest it, moved lower again, and earnings saw price now at around 37. So this depends on how price action behaves today. If it moves lower today, that bearish thesis would still remain intact and I would leave it open. If it moves higher, if it closes above 37.77, I would close this trade and move on to the next one. So that's the uncertainty aspect with earnings. But a lot of the time, when you see a gap up with earnings, we tend to see a gap fill or move lower before continuation higher or continuation lower. So for now, I'll keep this trade open for today, see how it does. And if it stays high, it stays elevated, close it. If it moves lower, keep it open. JP Morgan. So JP Morgan was my big bank pick because it's the best performer of big banks compared to Goldman Sachs, Morgan Stanley, Citi. JP Morgan, from a relative perspective, has been performing very, very well. And this was a bullish idea from last week where we saw a pullback, a bit of a 2 intraday rejections, bullish price action, and price is still higher despite the fact that markets have moved a little bit lower. JP Morgan is still outperforming the overall market in the short term, which is it's a huge positive. I do still see price again continuing to that 144, 145 area. And again, that's very much dependent on systemic risk. If the overall market continues to move lower after this week, then fine, maybe JP Morgan will move lower. But I still view JP Morgan as a very attractive pick due to the fact that it is the best in class when you look at the major banks. So this thesis very much still remains intact and slightly profitable. All right, moving on to NVIDIA. So NVIDIA was a longer term play. There was a short term entry a couple of weeks ago where I was looking for a revisit back to 188, which happened, and ideal time to take profits. But now, if you take a look at the weekly time frame, we had this consolidation area for almost a year or half a year, with 190 and 120 acting as resistance and support respectively. A bit of an inverted head and shoulders, strong breakout, and I would view that as a neckline break and a bit of a retest this week so far. But the fact that it's broken above this neckline, that is a change in structure to a more bullish tone. And I view NVIDIA being one of the best in class in semiconductors. So this is a longer term bullish play. And I think now is a good time to potentially start accumulating shares of NVIDIA for that longer term thesis. If you are looking for shorter term entry points, I still think it's a good time to look at potentially a short-term entry point, bullish entry point, if we see a pullback towards 21-day exponential moving average, some bullish price action, and then a move higher towards 211 or so. But we have resistance at around 220 and 211, so it'll be a credit spread kind of trade. And I think a bit of patience here for NVIDIA is required if you're a short-term investor or a short-term trader. Longer-term investor, I think this is a great time to look at accumulating shares of NVIDIA. And the new idea that I have for you today is Moderna, mRNA. Moderna, part of the biotechnology subsector. And we are seeing this decrease in momentum on the daily time frame with major resistance, not only at around 177, which price actually broke above, but also at 210, which price couldn't really break above that. We're now seeing a lower high and very bearish price action. So from here, I do expect a continuation lower, where we do have support at 170. If price reaches there and breaks below that, the next key area support is at around 160 or so for Moderna. So with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week ahead. I will see you next week. Goodbye.